Um, yeah. So what I was saying, when you think about the consequences of the tariffs, you gotta think first about the mechanic effect. Mechanically, what it does is that, well, you have the 10% tariffs on everybody. You had the reciprocal tariffs that then were suspended for 90 days, so they could initiate their deals. But you had, in particular, a couple of weeks ago, the very acute escalation of tariffs and counter tariffs with China that culminated in a 145% tariff rate for China. And here we're going into something else, because at that point, it's not that your trade becomes super expensive, is that your trade becomes, for a lot of it, if not most of it, economically unviable. It doesn't make sense to bring your product to the U.S. market, or if you are importing an intermediate good, it doesn't make sense to continue to produce whatever you are producing. So that would amount to a very significant disruption of global trade. Even before counting for the other countermeasures that China applies, export restrictions on critical minerals, and so on and so forth. So when you're the rest of the world and you're looking about at what's happening here, I think that what you have to keep in mind is that it just creates a huge amount of uncertainty, a huge amount of unpredictability, and it has to make you question, on the long term, on the medium to long term, can we continue to have a globalized system with the US occupying such an important role? This is not the US that built the global trading system. This is not the US that built the WTO. And so I think that the big question on the minds of anyone who is a business leader or a government leader who has a little bit of a long-term vision is what comes next. And whatever we are heading to next is not something that is going to get built from one day to the next. There's going to be these negotiations with the Trump administration. You cannot decouple from the United States from one day to the next, because they are so systemically important. But I do think there must be a discussion behind closed doors about what kind of globalization is going to come after that, and that's something for which everybody has to keep an eye open, an ear open to what the leaders of the countries, the heads of state, communicate. I think that we have maybe some signs of that. There was a progress on the Mercosur agreement, but it's very early into this process, and we have to play it by ear. Can we go to the next slide, please? So yeah, but for the moment, focusing on the shorter term, what you have there on the graph on the left is an uncertainty index. Basically, what it does is that it reflects the prevalence of search results, wanting to search information for policies, asking questions about these trade policies. And as you saw, there was a bit of that during the first Trump administration, a bit more during the pandemic, when there were also some other kinds of restrictions, mainly targeting strategic products back then. But it has nothing to do with what we have right now. We're into a different dimension of uncertainty, and you can understand that given what you have reflected here on the right, which is the average effective tariff rate on imports from the United States. So that is once you kind of synthesize everything, once you just grab the rates that are applied from all these different tariffs, auto tariffs, steel and aluminum tariffs, blanket tariffs, reciprocal tariffs. That's what you get as an average, a weighted average applied to the U.S. imports. You see that you have different dots there, because obviously the picture with tariffs is so volatile that depending on what level of escalation and what level of exemptions you have on a given week, that varies. If you want to do the chronology, you can just see that at Liberation Day we're at 26%. When we started escalating with China, we went up to 50%, but after the first rounds of escalation with China, we had that exemption on the other reciprocal tariffs. So the combination of 145% and exemption for all the other reciprocal tariffs lands you at about 28%. I don't think the details of these numbers are so important as their order of magnitude. I think what's important to take into account here is that you're going from one day to the next from a fairly liberalized economy to the highest level of tariffs that we've had for a century in the United States. And crucially, when you had those tariffs back in the day in the United States, it was an era where, okay, the US was on its way to become the most important economy in the world, but it was nowhere near as interlinked, and it did not play nowhere near as important a role as it does today. It was not yet the emitter of the global reserve currency of the most important currency in the world, which is the US dollar. And certainly also government was not as big, so they could finance it mostly through tariffs. Then you had that process of liberalization. So this is a very important shock to the rest of the world. And from the perspective of the rest of the world, it's an important shock to revenue, especially for economies that rely a lot on trade to the United States. For the United States, it's an important shock to on the input side, as I was mentioning earlier, something that is going to create imported inflation. And that is going to hurt the purchasing power of consumers, and that is going to also create more costs for businesses operating in the United States. Can we go to the next slide, please? So when we look at what the data says about the effects that this is already having on the US economy, you have some interesting patterns emerging. One that was not necessarily, I mean, we had some signs that this could happen, but we are now seeing concrete evidence in the data that it is happening, is what we call the process of front loading. That economic agents, firms and households are, obviously very attuned to this conversation about the tariffs. The president has been very vocal on his will to impose them, and they have been all over the economic news. So there is an awareness amongst U.S. households that this is going to create inflation. This is going to make consumer goods more expensive. And after we saw, and this is what I have here on the graph on the left, the month-on-month change in retail sales. After we initially saw signs in January and February that the American consumer was kind of tightening its belt, I think that as the intensity of the trade war started to become evident, first on the tariffs that were imposed on Canada and Mexico, then we have the U.S. consumer realizing that these goods are going to become more expensive later in the year. And even though the economic outlook is looking increasingly negative, they've started to increase their consumption to try to get ahead of these tariffs. We also see evidence of this when we look at the trade balance. So that's what you have on the right, on the graph on the right. This is again the differences between exports and imports in the United States. Obviously, is in deficit, and what we see is that well, we had a huge increase in January and February of the extent of this deficit. And this is again a sign that the agents in the United States, they are importing more to try to get ahead of these tariffs. So on the one hand, you have these consumption numbers that if you just were looking at them by themselves, they would be signs that demand is strong. But when you think about the fact that these are maybe going to be compensated by less consumption later in the year, then you have to realize that there's something quite odd happening here, and that there are risks to demand in the United States that might not be as evident now, but that are going to be probably going to become more evident later in the year. Can we go to the next slide, please? There we go. And when we look at other components of demand, so of course consumption is the most important one, but another important component of consumption, especially when we think about things like capital goods, about industrial materials such as metals or wood. One thing that we have to think about is what is the stance of firms, what is their confidence about their future, and what is their desire for investment. So obviously these things have been happening pretty quick. And some of the data that we have to capture at the earliest moment the sentiment from businesses is survey data conducted here by the Federal Reserve on the graph on the left, asking the survey respondents what is their opinion on the future business climate, on their intentions for employment, on their intentions for capital spending. And what we can see is that starting from February, these have been on an increasingly downward trajectory. So the business community in the United States pretty much, even if some of them maybe at the beginning of the election were in favor of Trump because of the regulator agenda and so on and so forth, what we're seeing is that more and more people are realizing the very concrete effects that the tariffs are going to have on their cost structure, and all the uncertainty that the way in which tariffs have been implemented is created, and have decided to put it to go into a wait and see kind of position, and this is going to result in a contraction of investment. Also, since we're looking at the agenda of the president and the Trump administration, realize that it hasn't all been about tariffs. Of course, there's also DOGE, the Department of Government Efficiency, that has been engaged in a pretty robust push for reducing the size of the federal government, and especially the amount of people that are employed by the federal government. And when we look at indicators of layoffs, of announced layoffs, that's the graph that I have on the right. You can see that pretty substantial spike on the left for February and March, of a really big spike in layoffs at the government level. Now, it must be said that even with that large spike, employment in government is not large enough to cause a substantial macroeconomic effect on the unemployment rate. But it is I think going to have an effect on the functionality of the federal government, and a lot of businesses do depend on that. It is, however, not going. We don't have a lot of evidence that is resulting in significant savings for the government, since what really makes the deficit are other things like health spending, defense spending. But we are having this effect that it's not always easy to measure the functionality of the government, but we know that there are a lot of services such as I don't know, to give an example, the agricultural sector depends a lot on the forecast of climate conditions that are made by the USDA, the Department of Agriculture, things like these, where these are public services that they don't have anymore. And so this is something that is important to take into account. Can we go to the next slide, please? So just to take the temperature on insolvencies, so the data that we have on insolvencies and other indicators of financial health, it's important to keep in mind that these indicators are pretty backward looking. So it takes a little bit of time for the trends in the economy to manifest in this kind of data. That's why, for instance, what you see on the insolvency data for the United States there on the graph on the right is that you had gone through this convergence period after the pandemic between 2021 and 2024, where things were going back to normal, interest rates were higher, cash buffers were being eroded, and so you saw that normalization of insolvencies peaking in mid-2024, and since then we're stabilizing around the 2024 levels. In Canada, it was kind of the same situation, maybe stabilizing at higher levels. But that's where we are at the moment where the Trump administration begins. However, when we look at some other indicators, such as delinquency rates on loans to businesses, what you have there on the graph on the left, the picture is a bit more nuanced. So this is, again, the rate at which firms are becoming delinquent, late underpayments on their loans. And what we see there is that when we look at small businesses, so that's what I assimilate to that graph on the to that line, to that sky blue line. Because these other banks here in this graph, they are mostly regional banks that have a higher proportion of SMEs in their portfolio. So you see that those delinquency rates were already rising since 2022. And furthermore, even when we look at the bigger banks, you see an increasing trend in delinquencies towards the end of the year. So already you were going into an economy where balance sheets, firm balance sheets, which were very healthy during the pandemic, are already deteriorating. And so we can expect that with these shocks that are coming at the beginning of 2025, the environment in terms of payment behavior is going to become more difficult. Now that, as I said, might not happen straight away because there's front loading of demand. Probably still some good consumption there at the beginning of the year, but it will become evident as we go through. Can we go to the next slide, please? Yeah, just very quickly here, something that is important to take into account in the financial sphere, something very interesting has been happening, which is that as you see, there's a lot of turbulence in financial markets, equity markets correcting massively. And normally when that happens, what you would expect is to see investors taking their money out of the equity markets and putting them on U.S. Treasuries, on so-called safe haven assets. But something interesting has been happening is that we have seen a rise in the treasury yields. We have seen a rise in the treasury yields, which mean that investors are taking their money out of these kinds of assets, and at the same time we continue to see a pretty intense depreciation of the dollar exchange rate. So what this is indication of is that we are having capital flights, that we're having money going out of the United States. And since we have this simultaneously at a moment where confidence around the leadership, around the presidency of the United States, around the executive is being eroded, then we have some early signs that international investors might be starting to lose confidence in the U.S. Treasuries as a safe asset. Now that is going to be important as we head further into the presidency, because we know that is kind of what you had there on the graph on the right. We know that public expenditures are doing nothing but rise structurally. We know that they want to do tax cuts, so there's no perspective for the deficit to be corrected. And if besides that, you have a higher expenditures on that, then you can get into a situation where the financial health of the United States starts to be questioned. And then if we get to that situation, then it all depends on how the administration reacts. And given that we have such an unpredictable president, well, I do not, it wouldn't be responsible for me to make any forecast. We just have to wait how they would behave in that situation. But it will be a situation where there is a material risk of financial crisis. Can we go to the next slide, please? I would say that one of the things that are maybe a little bit of a reasons for, I don't want to say optimism, but to think that there is a resilience capacity in the United States is the fact that firm balance sheets are relatively healthy. It's what you see here on the graph, on both these graphs actually. In both of them, you have a curve of credit to households as a percent of GDP. And what it tells you is that you had a huge moment of debt during the prelude to the global financial crisis in 08. And since then, you have seen the households get more and more out of debt, their balance sheets becoming healthier. You have also been through a period where there's been a lot of appreciation of asset prices, especially equities, but also homes. So balance sheets of houses are relatively healthy, less so in the last few months because of course, of the huge correction that we had in equity prices. But I think that there might be room here for the consumer to get a little bit into debt. Maybe that's already happening a little bit to smooth the effect of the trade war on their consumption. I don't think that that's going to prevent a recession if we're going into one, but it might make it a little bit less intense than it would have been otherwise. Can we go to the next slide, please? And just to finish a little bit on Mexico, because of course it's another important country in Latin America and one that is very, very exposed to the trade with the United States. Obviously, trade with the United States representing close to a quarter of GDP. The positive thing is that in relative terms, relative to other countries, Mexico ended up getting a little bit more forgiven in terms of tariffs after Liberation Day, just because everybody else got so many. But still, even with the USMCA exemption, they are being subjected to the automotive tariffs, except for the one on parts. They are being subjected to the steel and aluminum tariffs. And it was already an economy that was ending the year 2024 kind of in contraction, contraction in the fourth quarter, as you can see on the graph on the right, driven by the manufacturing sector. And if you look at the survey indicators that what you have on the left, which is PMIs, you can see that it's in pretty bad territory. So Mexico almost definitely going into a recession. Just going to finish here on the last slide. One thing that I wanted you to take into account. Can we go to the last slide, please? Yeah. What we saw during the past few during the past experiences in the trade war, is that we do see a lot of rerouting of products from China through third countries like Vietnam and Mexico into the United States. And given that we are in a period right now where we have very high tariffs on China and low tariffs on the rest of the world, there is that opportunity for there to be that kind of rerouting. What you have there is kind of evidence of that, of the fact that between 2019 and last year, you saw a rise in market share from Mexico and Vietnam, both as a share of imports going into the United States and as a share of exports in China. So be on the lookout for this kind of behavior. And it's also an opportunity to do a little bit of absorption of what's happening with the trade war, at least in the short term. I think I'm going to leave it there. I'll give you the word, Patricia.
Okay, thank you, Marcos. So now we're going to move to Latin America to see the negative impact of the U.S. Trump administration policies on Latin America. Let me just wait for the slides here.
Just a minute. Just a minute.
Sorry, there they are. Okay, so I'll first start. I see that four main channels of contagions for Latin America from the U.S. Trump administration policy. One is about a stricter immigration policy. So since the start of the new Trump government, he already gave a strong focus on trying to put stricter rules, trying to avoid immigrants to the U.S. And so we believe that we should observe a drop in the remittance. So Latin American citizens living in the U.S., working in the U.S., sending these resources to their regional countries. So this kind of resources could be very large for some economies, especially Central American countries are more vulnerable. In countries like Nicaragua, Honduras, or El Salvador, this could be even higher than 20%. So this means that lower remittance could affect household consumption in these countries, additionally to the pressure in their domestic job market. During the last years, remittance was actually very resilient, as we can see in the second chart, and remains at a very high levels during the last months, explained by a heated job market in the U.S., even during the COVID crisis, the strong fiscal stimulus that was put in place by the U.S. government at that time. So, but for this year, we would expect this to reduce because first, a stronger migration policy. This also deter Latin American citizens to try to migrate to the U.S. as well. As we can see in the third chart, the flows in the U.S. Southwest land border has also decreased significantly, like 70% during the last month, comparing October 24 until March 25 of the previous period. There was a decrease in 70%, in addition to the fact that we would expect a lower activity in the US this year with a strong slowdown. Of course, as Marcus mentioned, there's a lot of uncertainties in this now in terms of GDP growth forecast for the US, but initially assuming that activity could decelerate from 2.7 to 0.6% growth. So lower growth should also affect the job market, and finally remittance as well. So I think this is an important source of contagions for Latin America, and especially for Central America. Then moving on to our next slide, it's about exchange rate volatility. Well, actually, last year's Latin American currencies, they were already highly affected, already depreciated strongly due to the external scenario, even before the U.S. election, but because of resilient activity in the U.S. and all the uncertainties at that time about the pace of rate cut by the Federal Reserves that were applying in a strong USD and affecting emerging currencies and including Latin American currencies as well. And then after Trump was elected for a new mandate, there was also initially an idea that this could further strengthen the USD thanks to a higher risk aversion and the expectations that Trump would cut further taxes that would imply in a short-term higher activity. But actually, after he took office and there was a strong focus on increasing tariffs and the escalation in this trade war, we have actually observed a weakness of the USD, and this has also favored Latin American currencies. It's not enough to compensate the losses observed last year, but it has mitigated somewhat, and there was some kind of stronger currencies due to the worries about the impact on the tariffs on the U.S. activity, in addition to some recent sell-off of 10-year treasury bills seen more recently in the U.S. market. Then this is also a challenge for the central banks in the region because, well, there's now more uncertainty about the pace of rate cuts in the U.S. due to also to the dual work of by the Fed. So the worries about inflation, of course, tariffs affect inflation, but on the other hand, there's also expectation of lower activity, and there's also the worries about unemployment rate. So of course, this is another certainty for the central banks in Latin America. Okay, then going to the protectionist trade balance. Well, generally speaking, we see that Latin American economies, well, of course, with the exception of the Mexico that Max already talked about, that's certainly a totally different story. But in terms of, except for Mexico, we see that countries in Latin America are relatively less vulnerable to the more protectionist U.S. trade policy. First, because we have some countries, like the case of Brazil or Argentina, are still very close to trade. Yeah, like in Brazil, exports represent only 15% of GDP. In addition, there's also a moderate bilateral imbalances, as we can see in the second chart. So when we take into account the largest economies in Latin America, excluding Mexico, and the 10-year U.S. trade balance with these countries, we see that actually the U.S. holds a surplus with these countries, and with the exception of Ecuador. But despite the case of Ecuador, we're still talking about a deficit of only $2 billion. So it's not something significant. Yeah. So this also helps to explain why the Trump administration, despite all the critics saying that we are very protectionist in countries like in Brazil, they applied only the basic tariffs of 10%. Yeah. So this helps the region that has a relatively lower tariffs than other regions. Well, I know that there's a pause of 90 days for countries that are suffering from higher tariffs. But anyway, if you take into account what was originally announced, we were in a relatively better situation, this 10% tariffs. In addition, the effective rate, in fact, would be lower than this 10% because, well, we have other products that are, for now at least, exempt from tariffs like energy and some critical minerals. Yeah? So this reduces the effective tariffs. In terms of the sectoral tariffs, well, then we have tariffs applied to 25% to steel and aluminum. That, of course, is also applied for Latin America. But here you see that the main impact is for Brazil in terms of the steel industry, that about 60% of the steel industry exports goes to the US. But it's more something impacting the industry and not something as negative spillover effect for all Brazilian exports or for the whole economy. For Argentina, it's more aluminum, but as the case of Brazil, is more located for the industry and not a widespread negative impact for the hub country. So we see that sensitiveness of exports to the US for Latin America countries, it could be really low in terms of GDP. For Argentina, that's about 1% of the GDP, or less than 2% in the case of Brazil. And then it's relatively higher for Ecuador, for instance, that's about 6% of GDP. Okay, we move then to our next slide that here we break down the composition of the largest economies of Latin America exports to the US. So in the case of Argentina, we see that from the exports, like 35% are related to oil exports that, as I mentioned, are exempt for now from tariffs. So this reduces the effective tariffs for Argentina for something about 6%, not 10%, the basic tariffs. In the case of Brazil, we have 19% related to the oil and gas industry, so also reducing the effective tariffs to something about 8.7%. Is followed by the steel industry, as I mentioned it, that is about 14% of all exports to the US. Despite the 25% tariffs, it's important to say that what Brazil exports in terms of steel to the US is mostly related to semi-finished steel. So, and the US has no capacity to totally replace to local production in the short or medium term. So, well, you would expect a relatively lower flow of exports to the US because expecting lower activity and the tariffs as well, but not a totally disruption. So this mitigates actually the net negative impact. In terms of Chile, we have that 33% of exports from Chile to the US are related to the copper industry. So that's also it's also exempt from the tariffs for now. So effective tariffs for Chile is about 5%. But here is an important remark because the US administration is actually conducting a study about into critical minerals, about national security. And then once we have the conclusion of that, they may apply tariffs. So, and then this would certainly affect copper exports, and this could have a negative impact on Chile. Yeah, also because about not only 33% of exports to the US are related to copper, but actually in terms of total copper exports, about 30% goes to the US. So it's really an important market for Chilean copper exports. In terms of Colombia, we have that 43% of exports to the US are related to oil and coal. So again, we have the case of exemption here. Then the tariffs applied actually are about 4%, so much lower than the original 10%. For Ecuador, about 27% are related to oil. Yeah, so the tariffs could be something about 6%. But as I mentioned initially, for Ecuador, the sensitiveness of exports to the US is relatively higher than for other countries. Yeah, so it's about 6% of GDP. And finally, for Peru, 25% are fruits, followed by pearls as well, and copper with 10%. So while Peru is also a major producer and exporter of copper, like the case of Chile, there's not that reliance on for copper export in Peru from the US market than you have in Chile. So of course they would be vulnerable to, in case the US decided to impose tariffs on copper, but initially relatively less than the case of Chile. Then moving on to our next slide, here's about the second round effect of the more protectionist trade policy in the US to Latin America. I think this is the main point actually, because as I mentioned before, I see that Latin America is in a relatively better situation than other regions in terms of the position of tariffs, but we are certainly not immune, and you have the negative side effect and the second round effect as well. So with the escalation of a trade war, of course, this affects global economic activity. So this would affect Latin America, demand for Latin American sports, and including the fact that the trade war is mostly concentrated between the US and China. And China is the main market for exports of Brazil, for Chile and Peru, as you can see in the chart here. So the representativeness to GDP is higher than the US for this market. Yeah. Another fact about lower commodity prices, actually, we have seen recently a slowdown, actually, especially in energy prices because of this trade war and the worries about this could prompt to a lower global growth. And finally, about a possible redirection of Chinese exports. Yeah, so actually, this is already worrisome. We have already some industries in Latin America and globally speaking and worldwide as well, that complains about the interest of cheap imports coming from China. And well, if this over 100% tariffs applied from by the US to China, well, there's probably they're trying to allocate exports, Chinese exports to other markets. So this could also affect Latin America. And just to highlight in the second chart how commodities are important for Latin America in terms of total export, 75% the case of Ecuador, relatively lower in Argentina, 34%, but despite that, it's still very significant representativeness. Okay, then we move on to next slide, please. Just key takeaways of our main macro projections for the Latin American region for this year. So in terms of GDP growth forecasts, the average GDP growth for Latin American region, we're expecting growth to lose steam this year, slightly lose steam compared to the previous year, from after estimated growth of 2.2 would grow by 2% this year. Of course, the certainties are higher than usual. Yeah, with all the trade tensions, global trade tensions. But for now, we're expecting some slight growth deceleration. Considering the main market, well, we have this strong growth deceleration in Mexico, as Marcos talked about. So for now, with a GDP forecast of 0.2% for this year. But we're also expecting growth to decelerate in Brazil from 3.4 to 2%. And this is explained by a recent retightening of monetary policy in the country that will have a negative side effect for the economy, especially during the second half of this year. And despite a good outcome for agricultural activity for this year, we're also expecting some growth to decelerate in Chile, but from 2.6 to 2%, also with worries about the global tensions. In Peru, but coming from a high base of comparisons, just a slight growth deceleration to 2.8%. On the contrary, we would expect a relatively higher activity in Colombia, explained by lower inflation, also allowing central bank to cut interest rates. But despite that, we see that business confidence still at low levels there. In Ecuador, after a recession last year, due to, especially because of the energy crisis, we expect activity to rebound this year by 1.5%, basically because of the improvement of this energy crisis and the country faced last year during a period like many hours, like 14 hours of blackouts. So of course, if this improvement in the energy situation, this would also boost activity and allow it for this recovery this year. And finally, I think that the main highlight in terms of GDP growth for this year is certainly Argentina. So Argentina faced 2 years of a recession in a row. First in 2023 because of the drought affecting agriculture. Then last year, after Milei took office, all the adjustment that was put in place, but that had side effects in the short term. And for now, actually, we already see the economy is actually rebounding, has already left the technical recession. We're expecting activity to grow 4.6%, mostly driven by a strong improvement in household consumption as the inflation loses strongly steam, in addition to an improvement in poverty rates that, after strongly picking up during the first half of this year, already made strong progress along the second half of last year, and also assuming some improvement in investment thanks to a better business environment and recent announcements as well of the easing of capital controls in the country. Then we moving on to our next slide. Just I will go very quickly about inflation. We have a generally more benign scenario for inflation for Latin American countries in 2025. So for Colombia and Chile, we expect to gradually slow down along the year. In dollarized Ecuador and in Peru as well, we expect to remain well controlled. On the other hand, for Brazil, inflation estimations picked up in recent months. We are expecting inflation to end the year at a higher level than it ended 2024. Currently, estimates are around 5.7%. And the main points about the strong progress in inflation in Argentina. So after reaching a peak of 292% in April last year, it's already made strong progress, as we can see in the first chart. And as well, when we take into account the market estimate for year-end inflation in 2025 and 2026, that also improved along the last months, and they are expecting to end this year in 27% and reducing to 15% next year. Of course, there's still high uncertainty since the country just removed capital controls, just reduced and changed the exchange rate regime. For now, the market reacted very well, but well, there's still a lot. We still need to monitor that, and this is still in a vulnerable situation. But for now, the baseline scenario is of a strong improvement in inflation in the country. Finally, in terms of monetary policy, we expect in the next slide. We expect central bank in most countries to continue cutting interest rates. So still some space for residual rate cuts in Chile, Colombia, and Peru. On the contrary, in Brazil, the central bank has increased interest rates since September last year, already an increase of 375 basis points, reaching 14.25%, and will probably not end there. Yeah, so deliver a new hike in the May meeting, and the market believe that interest rates should end the year at 15% in Brazil. So this means a real interest rate when we remove the impact of inflation of almost between 9 and 10%. So really a really high level of real interest rates, of course, affecting households' consumption, payment capacity, as well as business payment capacity. And this moves us to our next slide that talks about payment experience in Brazil and the number of Chapter 11 requests that observed a strong pickup in recent years. In 2023, the number of requests increased by 69%. Then last year increased more at 62% compared to the level of 2023. Take into account the first 2 months of this year, those was some improvements. So there was a reduction in the 2 first months of this year of 11% compared to the same period of last year. But we are not expecting a strong improvement for this year, as I mentioned before, because of the fact that the central bank will continue to raise interest rates. Take into account some sector breakdown, we see that number of Chapter 11 requests in the primary industry sector was still increasing this year. In terms of sector, in terms of size of company, small companies were still observing a slight increase in the number of cases. And finally, the next slide, just to show that we have a similar situation in Colombia in terms of Chapter 11 requests. It's observed a strong increase last year and continued to increase during the first 2 months of this year, increasing 29% compared to the same period of last year. And encompassing different industries, with exception of the extractive industry and the agriculture industry. Well, these were the main points from my side for now. Thank you for your attention. We are now going to I think we still have some time for some Q&A. Okay, thank you.
Yeah, totally, Patricia. Thank you so much for your presentation. I'd like also to thank Marco for his presentation as well. And well, we have lots of questions here, guys. Possibly we won't have time for all of them. Anyways, I'd like to start one question for you, Marcos. This trade war that you just showed us possibly will make imports for the US more expensive, right? If that's the case, do you think that this will drive inflation to a higher level? And if so, what about the interest rates? What do you think about the all things together that I just mentioned?
Inflation, yeah, most possibly yes. That's our baseline expectation is that inflation is going to be rising more to give some reference frameworks. So we are now 2.4. The natural dynamic of the economy was to head down to the target of 2%. But now what we expect before the tariffs, we were expecting things to stabilize around there. Now we're expecting things to be picking up again in the next few months, and so that we end the year more closer to 4%. So that's the most likely situation. The only situation where I would see that not happening is if the recession is so strong. I mean, if the impact on firms is so strong that we actually get a bigger than expected rise in the unemployment rate, and we get a strong enough contraction in demand that actually overpowers just the effect on prices, and we get so much demand destruction that actually even with the tariffs, like companies cannot transmit the prices, and we see something like that. But most likely we're going to see inflation. In terms of interest rates, I think we're seeing the Fed be in a very difficult situation because they have a dual mandate. They have to control inflation, but they also have to support employment. And when we get this kind of outlook where you have both inflation that is expected to increase and activity that is expected to decelerate, where they have to make some difficult arbitrages. What we are seeing from the Federal Reserve is that the framework they seem to be adopting is that we're still in an outlook where the bigger risk is inflation, where they don't see the risk to activity so far being strong enough that they want to deviate from their path. And so they might do a couple of cuts this year, maybe even as little as one, but for the most part, stay with rates broadly where they are. As we start getting harder numbers, and if we get numbers that are more disappointing than expected in activity, that might change. But for the moment, that seems to be the case.
Great view on that, Marcos. Thank you so much. I have another question now that's for Patricia. Well, Patricia, some economists say that Latam can even benefit from this trade war. What's your opinion on that? Does that make sense, or you have a vision against it? Tell us.
No, I don't think that the net balance is positive. Definitely not. I think that a global trade war could not be something positive for the economy as a whole. But of course, you have some markets always in crisis. You can have a specific industry, a specific sector that could benefit from a market that opens an opportunity. For instance, when we talk about the trade war between China and the US, especially the big focus on China and the US, during the first administration, when there was especially the focus of Trump, China, there was an increase in Chinese imports of agricultural products coming from Brazil, for instance. So I see that if this continues, this trade war between China and the US, this could open an opportunity for agricultures in Brazil, and also it's also a case of Argentina, to export to China products like soybean or corn or meat. Yeah, but at the same time, we need to take into account that prices could also be affected by the expected lower activity. Yeah, so but generally, these are kind of sectors that could have some positive effect.
Great. Thank you, Patricia. Thank you. Guys, we are running out of time, but I believe that we have time for a last question. And this question is very interesting. It came from our audience. It's from Mateus. He asks Marcos, what are the markets that will lose the most aside from Mexico and Southeast Asia? And do you think, is there any market that's going to win in this trade war?
So Mexico and Southeast Asia, that's what we saw when we looked at the exposure in terms of GDP. I mean, of course, Canada is also very exposed. It's all very number one, to say that we're going to see in the next few months, because we know that there are these negotiations regarding the reciprocal tariffs that are happening, and for some of the countries that were most exposed to that, that is going to be important. And when we think about Cambodia, Vietnam, some of the countries that saw important reciprocal tariffs, we have to wait to see what the administration ends up deciding. In terms of countries that can win, and I saw that there was a question related to this. I think that on the short term, I'm going to give you an answer very similar to that, Patricia, is that this is just so turbulent and such. The global trading system was a good thing that we had going. It was a stable thing, and it was a thing that is difficult to build. And so you cannot undo it and on the short term redo it in a way that is as functional. There is going to be a period of turbulence, and a period of turbulence is a period that is bad for business pretty much everywhere. And so everybody's going to be more or less affected. On the long term, however, what we have here is basically the US kind of saying that they don't want to be the global hegemon anymore in terms of trade here, that they want to do everything by themselves and look inward. And so that creates a sort of vacuum to be filled at the international scene. And there are I think that there is room for certain countries to benefit from this, most notably China. I think that China, they obviously the rest of the world have their different reasons to be skeptical of deeper ties with China. But after this, they are looking like they might be more serious, more reliable trading partners, and that if there is going to be a construction of a globalization that is built in parallel to the United States, then it makes a lot of sense to have China as a central node of that globalization. The other region that I think might win from this, and I say might, there are risks there, is Europe. Now, what are the risks? The risk is that, of course, we don't know how conflictual the relationship is going to get in the future, and Europe is very reliant on the US for its energy imports. They do have to diversify that dependence with other trading partners and other sources of energy that they might produce on their own. But I do think that there is, number one, some room for Europe to gain some foreign some human capital. People are not going to go to the United States. They're not going to go to Europe. It's going to create some incentives for them to liberalize a little bit, to get their act together, to try to create more national champions. And who knows, if the US dollar and the US safe assets keep losing the status that they have had during this past few years, during these last few decades, really, that might create an incentive for the Europeans to create a common safe asset, more demand for things like German bonds, or if there is a European safe asset, and the euro might win a little bit as a reserve currency, and therefore be easier to import capital to finance some of the investments that need to happen in Europe. I can imagine that. I'm not sure that is going to happen, but I could definitely imagine that making sense.
Perfect. Great view on that as well. Thank you. Guys, we ran out of time. Thank you so much, Marcos, once again, Patricia, once again. Great content that you give us today. This session was recorded, so we are going to work a little bit on it, and possibly we will send the entire video in YouTube for anyone else that can review or would like to check any type of content that we had. Thank you so much for the audience as well. It was a pleasure having you with us today. See you next month with another webinar, another very interesting topic for us to discuss. Thank you. Bye-bye, everyone.
Thanks, everybody.
Thank you so
Bye.
much.
Thank you. Bye-bye.
Bye.